So it did not take me much to become that $1 million in debt. Well, I was able to apply the principles of the teachings that Nelson Nash taught in this book, Becoming Your Own Banker, and I was able to pay that debt off in 39 months, 3 years and 3 months. All I had to do is I added one step to my financial life.
Hello, and welcome to the Infinite Financial Freedom Podcast, where we empower you with financial literacy and guide you on your journey to financial freedom. I'm Josh Metal, and today I'm here with Brent Kesler, founder and CEO of the Money Multiplier. That's a catchy name if I've ever heard one. I love it. Brent discovered the Money Multiplier Method, which we call the TMM Method, while paying off $984,000 in personal debt in 39 months. We're definitely going to dig into that, Brent. For the last 10 plus years, Brent has been educating thousands of people around the country on the dynamics of the TMM method and helping them on their path towards financial freedom. So, brother, I feel like we're kindred spirits already, having known you for 13 minutes. Welcome to the podcast. How you doing today?
Hey, Josh, fantastic, man. Thanks for having me. I'm excited to share with your listeners.
I am excited to learn from you. And I feel like there's going to be, for those of us who want to build passive income and have it grow beyond our monthly expenses, I feel like this is going to be an incredibly valuable session. And Brent just introduced me to a new saying, which is a short pencil is better than a long memory. So I feel like this is going to be one of those podcasts that you might want to sit down with a cup of coffee or tea and a shorter long pencil, your choice, we don't care. But I feel like there's going to be some notes for your personal investing notebook on this one. So play close attention, and let's jump into this thing, my friend. What is the Money Multiplier system or method, excuse me, and how the heck did you get yourself into $984,000 in debt? I got to know that.
Yeah, no, great. So anyway, just kind of like as far as high level, as far as the system, the concept, the Money Multiplier Method, it's a concept to help you build, keep, and create wealth through your own debts and expenses that you already have, right? So that's what we're just like trying to do here is we're trying to keep more of what we have, because a lot of people, including your listeners, they really, really know how to make money, but most people, they suck at keeping their money. They just do, I mean, right? They just don't do a very good job of keeping it. So that's what we have to do, is keep more of what we have. Now, this concept, Josh, anyway, I did not invent this. I didn't create it. There's a guy that wrote this book right here called Becoming Your Own Banker. Becoming Your Own Banker. And the guy that wrote this book, his name is Nelson Nash. Now, so like Nelson Nash passed away 5 years ago, almost 5 years ago to the date, in 2019 at age 87 years old. So I was introduced to Nelson. Nelson was my mentor in this. So the thing I recommend that all of your listeners do, they go find this book out there, wherever you buy your books from, Becoming Your Own Banker. And if you notice, it says Unlock the Infinite Banking Concept. So which goes really well with what your podcast is Infinite Financial Freedom, right? So this book completely changed my financial life. So I recommend that you add this book to your wealth building library, because it totally changed my mindset of how money actually works. Now, anyway, just to give you a little bit about my background, I'm a chiropractor. I no longer practice chiropractic anymore. I actually had clinics in Kansas City. I had 5 different clinics in Kansas City. I had associate docs in that clinic. So I haven't actively practiced since 2008. Actually, this concept that I'm sharing with you, I've been teaching now for 12 years and a month. I started teaching it in March of 2012, and here we are talking in April of 24. I sold my last clinic in 2017. And so anyway, the very first time I heard about this concept, I was at a chiropractic conference, and it was in 2006 that I was at that conference. And I heard this speaker talk about this thing, Becoming Your Own Banker, the infinite banking concept. And I thought to myself, that sounds really, really good, but it just seems too good to be true. There
Mm.
has to be a catch. And I'm sure Josh and a lot of the listeners have heard things like that, where it looks good, it seems too good to be true. Well, that was me. I heard it in '06. I didn't do anything. I bought this book. There was also an audio that went along with it. I brought it home from the conference. I put it on my shelf, never did anything with it at all. I go back now to another conference about 2 years later, and about 10 or 12 of my colleagues that were there at the previous conference are now at this conference. Now, the only difference between them and me, Josh, is when they heard the information the first time, they acted up on it and they implemented it in their life. And I didn't. So now I'm at this new conference, and I got like 10 or 12 of my colleagues going on and on. They're ranting and raving. They're basically throwing up all over me saying, Brent, isn't this banking concept the most powerful thing ever to build, keep, and create wealth, to pay your debts, to pay your expenses, all without working any harder, without changing cash flow, taking any additional risk, or losing control of your money? And I thought to myself, there has to be something to this, because there's no way 10 or 12 of my close colleagues are lying to me. Maybe one or two are lying, but not 10 or 12. So I went home to my wife, and it was in February of 2008. And I said, honey, we have to start implementing this concept in our life. So that's what we did. We implemented it. And at that time, because I had to know this number, I had to know, that was part of the exercise. I had to know what the number was that I owed to third-party creditors. And that number, Josh, was $984,711. Now, the question you've already asked, you said, how on earth do you get to be almost $1 million in debt? I know if you live in California, that buys a very small home, right?
Right.
But in Kansas, that buys you a boatload of stuff, right? So here's how I was in that debt. I had my student loans from chiropractic college. I had my chiropractic clinic. At the time, I only had one clinic. I also had the house that I lived in. I also had a condo on the Lake of the Ozarks between St. Louis and Kansas City. And Josh, if you have a condo on the Lake of the Ozarks, guess what you have to have?
A
A
boat.
boat and a wave runner. Yeah, man, you
For
can't have a
sure.
condo without a boat and a wave runner on the lake. I'm also an airplane pilot. So as an airplane pilot, I had to have my own airplane. So it did not take me much to become that $1 million in debt. Well, I was able to apply the principles of the teachings that Nelson Nash taught in this book, Becoming Your Own Banker, and I was able to pay that debt off in 39 months, 3 years and 3 months. All I had to do is I added one step to my financial life. I didn't have to change anything. I don't have to change anything that I'm doing, right? I don't have to change my cash flow. I don't have to work harder. I don't have to take any additional risk or lose control. I just add one step. So, like for you, a lot of people are probably real estate investors, right? I think both of you,
Yeah.
okay, so like both of you and I were talking offline a little bit before we started recording, and you have lots of dollars invested into real estate and buildings, right?
Right.
So this concept, in order to apply this concept in your life, it doesn't take away from anything that you're currently doing. Not at all. There's just one step that you're going to add into your financial life. And is it okay if I share with what that
Please.
is and the whole basis of this, or you want me to hold off?
No, let's get granular. I love it.
Yeah. So, okay, the whole concept, the infinite banking concept, it's all driven from cash value life insurance. So, a life insurance policy. Now, I know just half of your listeners just tuned out, or they said, all right, Mary, this guy's talking about life insurance. I'm going to go walk the dog, burp the baby, or go cook our dinner, whatever. Whoever's listening right now, that's what they thought because I mentioned the word life insurance. Because I know that all the listeners out there, they probably have a brother-in-law that sells life insurance. We all have a brother-in-law that sells life insurance. Well, let me be very clear. This is not that type of policy. This is not just a regular life insurance policy. These policies are specifically designed, specially engineered to have high, immediate cash value. Now, one more time on that, high immediate cash value. And when I say immediate, I mean within 30 days. So anytime, no matter where you listen to me, whether it's a live event, a podcast, a virtual, anytime I use the word immediately, my definition is within 30 days. So what that means is you put money into this policy and you're using that cash value immediately. Now, the thing that you're doing is you're putting money in the policy first. So that's the step that we're adding. Now, why on earth would we want to add that step? And why would we want to put money into a life insurance policy? Well, here's why. Because this is what the rich do. This is what the wealthy do. The number one purchasers of whole life insurance in the world are conventional banks. Conventional banks own more in whole life insurance than all of their land and their buildings combined. As a matter of fact, since 2014, conventional banks have quadrupled the amount of money that they put into these types of policies. Now, you ask, why would a bank do that? Is it because they're stupid or because they know something the rest of us don't know? They know something the rest of us don't know. Now, let me peel back the onion a little bit more. This concept, the infinite banking concept, is not brand new. It's not on trial. It's not being tested. No, it's been around for almost 250 years. So if you go research things like the Rockefellers, the Rothschilds, the Morgans, the Stanleys, the Barclays, this is what they did to build, keep, and create wealth. This is how Walt Disney funded Disneyland. It's how Ray Kroc started McDonald's. It's how Pampered Chef got started before Warren Buffett actually purchased Pampered Chef. As a matter of fact, this concept that I teach, I know that, okay, so like both of you and I, Josh, we're talking a little bit about Robert Kiyosaki before we came online. Obviously, like Robert Kiyosaki is, he's known and famous for his book, Rich Dad, Poor Dad. Well, he also wrote another book called Second Chance. And in that book called Second Chance that Robert Kiyosaki wrote, this concept that I teach is exactly what Robert Kiyosaki talks about in the book. The problem is when you read what Robert Kiyosaki writes about this concept, they make it too complicated and too difficult to understand. So when the person goes through and reads the book, they pass right through it and really don't understand what the meaning is of what Robert Kiyosaki is saying. Another person is Tony Robbins. Tony Robbins wrote a book called Money Master the Game. I can't remember if it's chapter 5.3 or 5.4 of that Tony Robbins book, but what Tony Robbins speaks about in that chapter, in that section of that chapter, is exactly what I teach. But once again, they make it a little too difficult to understand, and people read right through it, and they never dig in to seeing what this infinite banking concept is all about. So I've made it a mission in my life. I no longer practice chiropractic. I eat, live, and breathe this concept. I travel all around the country and I teach this concept. I never ask anybody to buy anything. I don't sell from stage, but I teach this concept. And guess what happens when I teach this to other people? People want to know more about how it is going to work in their life. And hopefully some of those people will work with us at the Money Multiplier, because that's what we do. A client never pays me a dime, ever. You would never. For example, Josh, let's just say you became a client of the Money Multiplier. You are never going to write me a check for a dime. How do I get paid? I get paid the same way your car insurance guy or gal gets paid. If you go to John Smith, the Allstate man, to buy car insurance, the check that you write for your car insurance isn't to John Smith. You write it to Allstate. Allstate pays John Smith a commission. I am a licensed life insurance agent in every state of the country. So whenever you buy one of these policies, you have to buy a life insurance policy in order to do this concept the way that Nelson teaches it. So the thing that you got to do is choose, who do you start that policy with? and hopefully I'm the guy you'll start this policy with because I'm the one that taught you. You don't have to do it with me. You can go do it with someone else. And a lot of times people will do this and not even use a life insurance policy. They'll use another vehicle to do it. So I'm teaching the method, and hopefully you like what I teach and you see how this builds, keeps, and creates wealth. And you become, along with one of my other 13,000 clients that I personally have around the country, and you start implementing this in your own life the same way that I do in my life. I own 28 of these policies. So exactly what I show you to do is what I do in my own life. I just don't tell you what I do. I show you my complete portfolio and what I'm doing in my policies and why I buy a new policy every year or every 2 years, because as your wealth continues to come in, as you continue to have more passive income, right? Now, Josh, I'm not on your level at all, but I will tell you that I keep very, very good track of my passive income. And when I say passive income, which a lot of that, as we talked earlier, is in deals in real estate. I own long-term rentals, short-term rentals. I own, VR or Airbnbs, but I like to do a lot of lending. So I lend money. I lend money on real estate projects like real estate development, sometimes individual houses or commercial buildings. But when I'm lending money, now I lend the money through the policy, and we'll get in that in a minute. But the thing is on those loans that I do, I personally like to be in first position because there's this saying, if you're not first, you're last, right? So I like to be in first position. Now, I'm not saying I never do a second position deal, but as I get older, I want to be in first position because if that deal goes south or goes sour, I can always foreclose on that real estate. I've never had to do that ever had to do that. I've had some people that are slow at paying and they get behind or delayed. I've never, ever, knock on wood, had to foreclose, but that's why I like the first position.
Understand that. So I love the framework that you're the scaffolding you're putting up for us.
Yeah.
I would like to go down to the foundation of the building. Like, take me back and let's do a case study on Brent. You had this 984,000 in debt. You learned this concept. You got the buy-in from your wife, which is a massive nugget that Brent gave us. Get buy-in from your spouse.
Yeah.
It's not good if you're going in two different directions. You need to be headed down the same path. And then how did you fund, and what was the mechanism that enabled you to pay off that debt?
Yeah, absolutely. Now, again, I'm just going to be full transparency. I have a full 90+ minute video on our website, www.themoneymultiplier.com. It's a full 90+ minute presentation where I go in to all the mechanics, the meat and potatoes of it, right? Of exactly how it happens. But here's how it happens high level. So the thing that you do is you're going to put your money inside of the policy, right? So, and now the amount that you put into the policy is up to you. And it's up to you how you pay it. And it's up to you if you continue to pay that same amount. So people put money into the policy monthly, quarterly, twice a year, annually. They can always lower the amount they want to put in the policy once they start. But most of the time they don't lower it. The only time you'll lower it is if you have a severe financial catastrophe or disaster that usually happens within the first 24 months of when you start the policy. As a matter of fact, of the 13,000 plus clients I work with, 91% of those that have been with me a year or longer come back for additional policies. Now, why, you asked, do you buy additional policies and not just continue to put money in the same one? Because each policy, Josh, is like a contract. And it's like this glass that I'm holding. Let's just say this glass only holds 10 ounces of water. There's no way I could ever get 12 ounces of water in it, no matter how hard I try. It simply will not hold it. The same thing with the policy, because when you construct that policy from the beginning, you, the client, are saying, Brent, I want to put in X amount of dollars into the policy. Let's just say it's $1,000 a month. Now I have people that put in $100 a month, and I think our largest client puts in $540,000 a month. So just pick a number between $100 a month and 540,000, and you pick that number, whatever works for you, right? So the thing is okay, so okay, now that amount establishes what that contract is. So you're telling the insurance company, hey, I want to put in $1,000 a month. And the insurance company takes a look at you, Josh, and they're saying, okay, let's take a look at Josh. Let's take a look at his age, his health, and to some degree, your gross income and your net worth. And they'll see, okay, and again, so for this, it's mainly age and health. They say, what amount of death benefit does $1,000 a month buy Josh? Now, I don't care about your death benefit, and you, Josh, should not care about your death benefit, because we are not putting money in this vehicle to buy a life insurance policy. Yes, it is a life insurance policy. You have a death benefit, but that's not the reason you're doing it. You're doing it to build the cash value, to be able to utilize that cash value to go out and buy your products and your services, your debts, your expenses, your investments, whatever you need money for. It's and it can be used for anything. Remember the word infinite? Infinite right here, infinite. You can use the money for anything that you want. The insurance company never asks you, why do you want to take a policy loan? And they never ask you if you plan on paying it back. They don't care, because the insurance company can never lose, because essentially what you're doing is you're borrowing against your death benefit. See, the thing is, all of us, Josh, on this call are guaranteed to die. Now, I like to use the word pass or graduate instead of die, right? But whatever word you like, die, pass, graduate, we all have an expiration date. We just don't know when it is. Well, with this policy, you have a death benefit, and the death benefit is always greater than the cash value. So let's just hypothetically say, Josh, that let's say you graduated, and let's just say, just for hypothetical numbers, that you had $100,000 of cash value in your policy, and let's say your death benefit is $300,000. So what happens at the time of your death? And okay, at the time of your death, let's say you had all $100,000 out of that policy, and now you pass. Well, the insurance company's not worried at all, because guess what? That $300,000 death benefit will pay off the $100,000 loan, because they've already given you that money while you're living and you're using it, and the additional $200,000 will go to your beneficiaries tax-free. So essentially what you're doing is you're using a portion of the death benefit while you are living. There will be plenty of money to pass on to the next generation. Now, I got off track a little bit. Let me come back to the MEC thing. The reason we have to do additional policies when we want to do more premium is because you can't overfill the policy. Because if the policy overfills, it becomes this thing called a MEC, which means modified endowment contract. Now, the MEC came into effect back around June of 1988. And guess who put that into effect? Our good old government. Now, why would the government put anything into effect that the consumer is maximizing and it's working for them? Because the government wants part of their share, right? Now, if I have listeners on here that think that they really want government control and they want government in control of their money, you're probably not going to like me. You're probably just tuned out right now, because I'm all about you keeping control and not giving up your money to other people. So
we don't let any of those people listen to this podcast, Brent. You're good. Go ahead.
Okay. So right. So anyway, that MEC limit came into effect because all these people were trying to stuff money into these policies, right? Because of the tax-free growth environment. The government says, oh, stop it. We only are going to allow you to do so much. And then if you try to do more, now that policy is no longer a contract. It's treated as an investment, and it's subject to taxation.
Yeah.
So when we design your policy, what we do, Josh, is we snuggle it right up to the mech line without going over it. We snuggle it right up to that line without going over it. And now, as time goes on and you're continuing to build, keep, and create wealth, have additional passive income, right? Infinite financial freedom, as you call it, we have more money. And we're like, what do we do with that money? Well, we just go out and get more policies. We can either get more policies on ourselves, or we can get policies on our spouse, our children, grandchildren, anybody that we have a vested interest in. Now, there will come a point and a time where you cannot insure your body anymore. And the insurance company makes that decision and they tell you what your body is worth. It's kind of scary, but the insurance company determines how much your body is actually worth and what they're willing to insure you for. And how do they do it? They take your age, your health, your gross income, and your net worth, and they say, this is the amount of death benefit we'll give Josh. And that number can be very different for different individuals. For example, let's take the homeless guy that lives under the bridge, and let's take a Jeff Bezos. Well, who's going to get more death benefit because who has more net worth, right? So that's how they determine it. And whenever you maximize yourself out, you can go and own and control policies on other individuals.
So Donald Trump could get a bigger policy than the New York judges say that his value is. So
absolutely, yeah. I'll buy Mar-a-Lago for what they evaluated it for.
We should go in on it.
I'll beg, borrow, and steal and find them, get the money somehow. Let me go buy it for that. What do they say? 12 million, or I don't even remember. Crazy money. I live in Florida. And again, I'm a Zillow nerd. I know we're getting off topic, but I'm a Zillow nerd. I go to Zillow like every day. I mean, it might be at nighttime or early in the morning, and I have like a half a dozen zip codes that I look at, right? That I look at every day because I want to see what is selling and what's coming on the market and stuff. And let me just tell you, Palm Beach, where Mar-a-Lago is, you can't even buy the lot next door to Donald Trump for a fraction of what they're saying it's worth. It's the craziest thing I've ever heard of. I can't see how somebody can evaluate a property like that, but it is what it is,
I saw somebody on X who did an inventory of his landscaping and the trees, and he's like, the landscaping is worth more than the valuation they put on this. I thought that was hilarious. But we're going to get way off topic if we go that way. So let's stay on the road. Okay. So I've netted out a couple of benefits here. Number one, we have immediate access to these. I think you called it a high immediate cash value within 30 days. So that's good. We can pull the money out, and I'm sure there's some limit to the amount we could pull out. So we should hit that. Then you mentioned that the death benefit is always bigger than the cash value, meaning that the number of dollars I've socked away in this investment vehicle, my death benefit's always larger than that by some percentage or multiple. And when I die or graduate, then that death benefit is tax-free. So that's a huge
Yep.
up leveling, and that is irrespective of the amount of the death benefit. If it exceeds the inheritance tax rules, it doesn't matter. Life insurance is tax-free, correct?
Yeah. Yes.
State and federal, correct?
Yes.
Okay, so that's a huge benefit. And then the growth of the cash value is tax-free. So let me ask you a question about that, because that's the piece that I want to dig into.
Okay.
I put this cash value amount into the life insurance, and let's just use an easy number. There's 100,000 in there. And let's just say that after a few years, the policy was returning, let's just say 5%. Okay, so I'm getting a $5,000 return on that cash value. And then let's say I borrow out of that cash value 100,000, and I go make an investment. When I sell that investment, or the investment that I make comes to its finality, comes to fruition, now I don't have to take that money. I don't have to take the profits from that investment and put it back into the life insurance policy like you do with an IRA. I can use that however I want and then just pay back the principal, correct?
And as a matter of fact, the principal doesn't even have to be paid back. So anyway, there's a
Got it.
lot you asked me, and so let me start uncovering what you asked. And if I missed something, ask me again because I want to
Okay.
answer every single thing you got. So the very first thing you said is how much of a percentage can I access? Well, the quick and easy answer is anywhere from 55% to 92% immediately, okay? Now it's all your money and as far as the dollar amount that's determined how much you can access is how you design the policy. Now there's pros and cons to designing the policy in different ways and each of our clients is unique because they have their own unique financial situation and anyway that's what makes us different is we Josh would say okay, here's what's going on in your financial life and this is the way I would design the policy and here's why. But let's say you say, well, you know what, I need a little bit more cash value the first year, then that's fine, we just change the policy design.
Got
So
it.
there's pros and cons, but just for the high level of this conversation, it's anywhere between like 56 and 92% that you can access immediately. All the money is yours.
Right.
You just can't access dollar for dollar immediately within the first 30 days. Okay.
Understood.
So, um, so now keep in mind the policy is constantly growing. Every day is better. The cash value increases, the loan availability increases, the death benefit increases.
Be-
Those numbers go up each and every day.
Because you're making automated payments and you're getting a fixed return on that and guaranteed return on that investment.
Well, even if you're not making the automated payments, but now keep in mind, so like this is not a single pay premium policy where you
Right.
pay premium one time and it's done.
Right.
So these policies are designed where you're either paying monthly, quarterly, twice a year, annually. So it's always up to the client of the mode they want to pay. They can always change the mode and they can also lower the amount. Obviously, the more you put in, the bigger growth. The
Yep.
less you put in, the less growth, but it's the same percentage. All of these policies also have a guaranteed growth rate plus dividends. And I will just tell you in today's environment, with the dividend environment that we're in, and the dividends are going up right now because the interest rates are going up. But
Sure.
even a couple years ago, when interest rates were really, really low, these policies were spitting out anywhere between 5.1 and 5.9%
Got
of
it.
growth. Okay.
Yep.
So typically, as interest rates are lower, the dividends are lower. And as
Sure.
interest rates rise, the dividends rise. That's typically how it works. Now, okay, so anytime you take a loan out of the policy, it is never taxable because just okay,
Loans
just
aren't
think about
taxable.
it. You've
Yep.
never paid tax on a loan. And whenever you take the money, the thing that you're doing is you're not taking your money, which is a cool thing about this. You do not take your money out of the policy. What you do is you put your policy up for collateral and take a loan from the general fund of the insurance company. So that means your money is continuing to grow even though you're using it. Now, there's a
Makes
guy
sense.
out there on our team. His name is Devin Burr. He's in Phoenix, Arizona. He's on TikTok and Instagram, has about 1 million followers. It's Mr. underscore Burr, BRRRR. But his name is Devin Burr. Go follow Devin Burr, watch some of his videos, and you will see how Devin shows how you can use the same money over and over and over again. He's a real estate investor. Now, I want to give you a real life example of what I did. Okay. I mean, I have a lot of loans out, I have a lot of investments. As a matter of fact, we talk about passive income. I can tell you my number as of March 31st. I have $121,871 a month that comes in as passive income, meaning passive income. I like to call it mailbox money because of my loans, investments, and so on. I know I'm not at your level, but I continue to increase every single month as I
Fantastic.
continue to increase my wealth. And again, okay, yes, I know you might think I'm a nerd that I know that number, but every single day, every banking day that I wake up, that's the first thing I do. I go look at exactly where I'm at. I want to know exactly where I'm at in all of my money because If I watch it, it'll grow. And if I watch it and report it, which if I tell you, right, like if I report my stats, they grow exponentially. An old
So
mentor
true.
told me that, and it's the most incredible thing ever. If you think it's crazy, start watching and monitoring your stats, and then go one step further, report them to other people. Report them, and they will grow.
So true. And people that grow their wealth spend time thinking about their wealth, which is what Brent just taught us. And they measure their wealth, and they're not looking at how much money they're making as much as they're looking at what is their total net worth, what is their assets under management, what do they control? Because we can make a lot of money and not be worth shit. That doesn't do anybody any good. We need to be growing our wealth and watching it. And that is a key differentiator between wealthy folks and people who are living in scarcity.
Totally good. Yeah, no, thanks for sharing that. Okay, now just to get back to me personally, just to give you an example of what I did. There's a guy that I did a loan to. He has a house or actually, he wanted to buy a house in Buffalo, New York, and he really, really wanted this house. This was going to be his own personal residence, and so at the time, and actually still, because this was like, I don't know, 7 months ago, um, he came to me and he says, Brent, he says, this house is 1.5 million. And the house is appraised at 1.7. He says, I need to borrow $1 million. He says, I got 500, but I need to borrow 1 million. And I told him, and again, his name is Joe. I'll just tell you his first name. I said, Joe, this is crazy. You do not want to borrow $1 million from me, because you know what I'm going to charge you? I'm going to charge you 16% interest, because that's what I'm getting right now at that
Yep.
time. And 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 again, Joe, yes, I know you and I love you, but you're not my family. So my family gets the family discount to borrow money from dad at 14%. But I'm not giving that to you, Joe. You're getting it for 16. So he says, yes, I want it. My wife wants it. My daughter wants it. Okay. So anyway, and of course he wanted to do it quick and a cash deal and all that. He
Course.
didn't want to go through the proctology
Of
exam of
course.
getting approved at the bank. And so chances are he would not have got approved at the bank, because he couldn't show the debt to income ratio and all of the crap the bank wants you to show. You got to, tiptoe on a
Yep.
couple of your small toes and all that in order to get a loan, and twist around. I mean, right. So you guys know how that goes. So anyway, so the thing I did is I loaned him $1 million, interest only, 160,000 a year, which equates to $13,333 a month in interest. So that's what he was going to owe me, is those interest payments only. I told him, I said, Joe, I'll do this for 12 months. Can you refi or do something different in 12 months? And he said, yeah. So anyway, this deal went down, I don't know, 6, 7 months ago, something like that. But so the thing I did is I had $1 million of cash value in my policy, right? So, and even if I didn't have $1 million of cash value in my policy, I could still take the money from part from my policy and part from the money that's sitting somewhere else in another
Sure.
avenue or the conventional bank. But I happen to have $1 million of the policy. So what I do is I call the insurance company. Very simple. Hey, I need to borrow $1 million. And they'll say, okay, Brent, what policy do you want it out of? I don't care. Just go find me $1 million. And when you get to 1 million, stop. So now that comes to me as a policy loan. Now, let me be totally clear. You have to pay interest on the policy loan to the insurance company, which is not a bad thing, because remember, I'm not taking my money out of the policy. I didn't take my
Right.
million out. I
It's
put my policy up for collateral. So
yeah.
I borrow this money at 5%, 5% simple interest. Okay. I borrow the $1 million. Now, keep in mind, my million is still continuing to grow. And I know if this is a
Sure.
little cloudy on that 90-minute presentation, I go through calculators and I show you how you can borrow at a higher rate than what you're earning and make money all day long. So I spell it out for you. So I give you the facts and the tools of how that's done. So I take the money and I borrow the million. Now let's call it 5% interest. So that means that I would pay 50,000 a year in interest, which is around $4,000 a month, roughly, right?
Yep.
Interest to the policy. But do I give a crap if I'm paying 50 grand a year if I got 160 coming in?
You do
Not
not.
at all. And not only do I have the 160 coming in, that whole $1 million is still in the policy, growing and compounding tax free. So I'm earning the growth on that money at over 4%, okay, over the 4%, which I said is anywhere, just call it between 5.0 and 5.9 because of the dividend. And every insurance company that we use has been paying dividends for over 124 consecutive years. So even though I can't guarantee, the insurance company can never guarantee a dividend, they've never not paid one for 124 years plus. Now, 124 years, that's 1900. So I want you guys to go back and look at your history books and see all the financial crap that our world, that our nation has went through since the year 1900. Have we not had a lot of recessions, the Great Depression, the housing bust, all of that stuff? And even during these times, the insurance companies were still paying dividend. So as that money now comes back to me, that 13,333 a month, I have a choice. I can pay that back to the insurance company, whether it's principal payments, interest payments, right? I can pay that if I want, or I don't have to. The insurance company never requires you to pay back the policy loan. As I said earlier, the policy loan is like a prepayment of the death benefit. So here's what I do. If I have no use for the money, then yes, as that money comes back in, I'm sending it back to the policy. Now, anytime I send that money back to the policy, that money becomes immediately available for me to use again.
Sure.
Unlike if you paid back a loan on a conventional bank and you paid more principal, you can't go back and say, Mr. Banker, I changed my mind. Send me that extra 10,000 in principal that I paid. No, 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 they don't do that,
Right.
right? You pay it and you pay it down. So you always have the flexibility of the money. But what I do is as that money comes in, as that number, the $121,871 a month in my life currently today comes in, I take that money and I look for other opportunities, which right now in this stage of my life is mostly first position lending. I'm not actively going out there looking to buy new properties and stuff like that, you know. And again, I'm not saying there's anything wrong with buying real estate. Actually, I own some real estate, which are high-end rentals on North Captiva Island, Florida. If you've ever heard of Sanibel and Captiva. Well, actually, I have a son, my oldest son and his wife are my property managers, and they're a pain in the ass to deal with, right? So, and they're my children, and they're a pain to deal with. So I don't enjoy dealing with property managers, even though they do an okay job, but it's still a pain to deal with them. So I like to lend money where I don't really have to think about it because I'm in first position. If the deal fails, I have the collateral. I just actually, as we're talking, Josh, today is a Friday. On Wednesday, I sent $1.3 million to a project in Columbus, Georgia. It's a real estate deal of townhouses and apartments. Now, how is that? Like the project is worth about $80 million. Well, I get about $2 million worth of first position equity on certain properties within that
Sure.
subdivision.
Phases
So
or
that's
whatever.
how I get first position equity. So that's what I like doing. So as that money comes back in, I usually send it back out into other lending deals. So the wealth just continues to grow and it becomes, what is that thing you talked about before? Infinite financial freedom, where your passive income is more than your active income. And as Robert Kiyosaki talks about, and in that game that he has, the game, I think it's called the rat race game. We were talking about the
Yep.
cash flow
Yep.
quadrant game. It's a purple board game like a Monopoly, but only the Robert Kiyosaki version. Isn't
Yep.
that the goal in life? To have your
Totally.
passive income exceed all your debts and expenses and everything that it takes for you to live? I honestly never ever thought I would get there. And I'm 56 years old. and I've been there now for about 2 years. And it's because, as you said earlier, I watch and I measure that money. Now, am I scared sometimes? Absolutely. I'm scared somebody that can come and knock on my door and take it away. I don't know who it's going to be, but I mean, but yeah, but it's okay to be scared, because because of being fearful and being scared that that might happen, that just drives me to continue, to push on. I might not be pushing as hard anymore, but I'm still pushing on, because if I'm not helping my own family, I'm able to help other people. Because guess what happens when you're able to have this kind of passive income come in? I have given more money to charity in the last couple of years than I've ever given in my life, that most of my friends even make in a year. I mean, again, I don't want to pat myself on the back, but I think it's important to give back. Like the late Zig Ziglar said, help enough other people get what they want, you end up getting what you want. You know, I'm a big Hawaii guy. I love Hawaii. So I sent $100,000 to Maui fire relief. They called me up and said, "Why would you do that? You live in Florida. You don't have any connection in Hawaii." Well, I love Maui. I'm actually going next Saturday to Maui, just with my
Beautiful.
family and stuff, right? But I mean, things like that. My brother he turns 50 years old. He turns 50 years old April 29th this year. He battled non-Hodgkin's lymphoma. So I gave, a bunch of money to the Leukemia and Lymphoma Society because of him. I love pets and dogs and horses, so I do stuff like that. So you're helping other people, and that's what you need to do, I believe, is help more people and serve others.
Brent, I couldn't think a better way to wrap up this podcast, man. And I know we've just scratched the surface of this. So I'll just add one more comment on what you were just saying. It occurred to me the other day, Brent, that until you escape the rat race, which is the moment you escape the rat race, as Brent said, is when your passive income exceeds your expenses. The only person you're really worried about is taking care of yourself, because each day you wake up and you have to go create enough to cover your monthly expenses for you and your family. So I know from personal experience, I was very concerned about myself and my family and survival every day.
Yeah.
Well, as soon as your passive income exceeds your expenses, you immediately become interested in serving everybody else on the planet, or everybody else who's in your tribe or your niche or your following or your community. It is a beautiful place to be, because you no longer have to worry about yourself and your family anymore. You can start worrying about everybody else that you want to have a positive impact on. So I love that we ended there. I was literally just in the gym having that thought yesterday. So thank you. It was a perfect way to end this, my friend. All
Thank
right.
you.
People are going to want to learn more from you. I want to learn more from you. So www.themoneymultiplier.com. Where else can people find you and learn from you? Mr. Burr, BRRRR, buy, renovate, refinance, rent, repeat, right? That's Mr. Burr. And he's on
Yep.
Instagram.
Yep, exactly. Yeah, his name is Devin Burr, and it's MR_Burr. TikTok, Instagram. I'm not a big social media guy, so I don't really know how all that works, but yeah, you can find him there. And also, Josh, I'll offer your listeners this book that I wrote called Mapping Out the Millionaire Mystery.
Right
I will
on.
send them this in an ebook version. So so all you got to do is just like send me an email, Brent, BRENT, Brent at themoneymultiplier.com. Ask me for the ebook. Say, hey, I heard you on the Josh podcast, right? And I will send you this ebook. If you really want the hard copy, which it's the same thing, I will send you the hard copy. You just have to pay for the postage, which is like $3. But again, I'm happy to send you a hard one. Most people don't ask for the hard one, but I wrote this book a few years ago with a guy named Chris Naugle. Now, let me just kind of give a shout out to Chris Naugle. You may have heard of Chris, especially in the real estate world. Chris Naugle had a couple shows on HGTV. He had one on House Hunters, another one on HGTV called Risky Builders. Back when Discovery Channel, and again, Chris lives in Buffalo, New York. Just go to chrisnaugle.com, Chris Noggle is now a colleague on my team. He teaches this stuff exactly like I do. He's kind of like the student become the teacher. I taught him everything, and now he teaches it. He is way out. Right. He's tons and tons of things out there on social media. He does 5 or 6 podcasts, webinars a week. He has something called the Wealth Wednesday webinar. Another segment called Ask Me Anything. Just go to Chris Naugle, Naugle.com. Look up Chris. It'll lead you back to us at the Money Multiplier as well. But yeah, man, yeah, that's how you can get a hold of us, is either go to the website or send me an email. Oh, I got to give another plug to my daughter. My daughter Hannah is 24 years old. She eats, lives, and breathes this concept. She works with me, teaches live events, teaches on stage. Hannah does a podcast every week called the Money Multiplier Podcast.
Oh, beautiful.
So anyway, 24, she just recorded her 101st episode this week. So 101 episodes every week she does a podcast. Hannah's way smarter at this than I am. So the both of us travel around the country. We speak on stage. So we're always, if there's any ever a stage that you guys think we should speak on, or virtual, live, or whatever. And the last thing I'll throw out there is, if you guys ever heard of a guy named Pace Morby. Pace Morby is my client. I'm in his community. Pace thinks everybody should know what I teach. So if you're watching Pace Morby, or you're in his sub-2 or Gator community, you'll see us, probably more so my daughter Hannah than me. But he's a great person to follow as well too. Pace does a great job.
Thank you, Brent. You've been such a wealth of knowledge. You've shared abundantly, my friend. And I'd love to have Hannah on the podcast sometime in the future and hear from her as well.
I'll connect you guys. Thank you for that. I appreciate it, Josh. And thank you to all of the listeners for taking time today to listen.
Hope this was as incredibly insightful for everyone as it was for me. Have a great rest of your day, everybody.